Hey everybody, I'm Rob Keenson. This is Gold Silver Pros. We're broadcasting this on Monday, February 13th, 2023, day before Valentine's Day. Uh, Recording this at 1:02 p.m. Central Time. It's because we are going to quote prices. This is your weekly market wrap, and the title of today's are All Eyes Are on the CPI number, which comes out tomorrow on Tuesday as jobless claims grow. We're going to get into that. I wanted to give you a readout on what's going on in the economy. As it sits right now, gold is down $4.98 on the day to 1858.13 after a nice brown rebound to wrap up, about the middle of last week. Silver is at 21.97, trading up 4 cents, doing overall okay. In the economy, looking at last week's data, we had not a whole lot of data announcement there, but we did have some higher than expected continuing jobless claims and initial jobless claims. On the initial jobless claims, last month we had 183,000. This month, 196,000 on expectations of 190. I find it interesting that with the BLS reporting 517,000 jobs created, that economists polled thought that we would have more initial jobless claims than last month. Data points don't really match. And of course, it got into that in last week's market wrap up, how that we didn't really create 517,000 jobs. We created a lot less than that. It was a bunch of adjustments by the BLS, but not as if we actually created those jobs. So continuing jobless claims are up to 1.69 million from 1.65 last month. So I do think that there's still some job weakness in there. Of course, we've had a lot of reports as company earnings reports are coming out for the fourth quarter, also seeing a lot of layoffs, especially in the tech sector, but in other sectors as well. So we're going to continue to watch that. I don't think employment is quite as rosy as government thinks, but we're going to continue to watch that data as it comes out. This week, of course, we're looking at the CPI. That's a consumer price index, which will come out tomorrow at 8:30 a.m. Eastern time. They're going to release that number, and I expect it actually maybe to stay the same or fall just a little bit because I think we're in a deflationary wave in the economy. And usually when you go through big periods of inflation, deflation, like we're going through right now, there's 3 cycles. I think we had our big inflation last year, and then inflation started to come down towards the end of the year. So we're in a little bit of a deflationary cycle before we hit another big wave of inflation. And I think we're going to see, as we go through the economic data, we're starting to see warehouse stockpiles increase, which is going to lead to deflation in prices eventually for certain things. Here on CNBC, title, Stocks Jump, Dow gains 300 points ahead of Tuesday's CPI report. I think everybody's expecting CPI to go down, and if it does, I do expect the markets to continue to go up, but it seems like it's pricing it in early ahead of the release tomorrow morning. The Dow Jones Industrial Average is up so far 359.15 points. That's up 1.06% to 34,228.42. The S&P 500 is trading up 46.29 points. That is 1.13% to 4136.75. The NASDAQ is trading up 186.44, up 1.6% to 11,904. And the Russell 2000 is up 22.57 points to 1941.38. If we look at the rest of the markets, going over to bonds, the bonds today are trading a little bit mixed. The 1 month is down 0.8 of a point. The 7, 10, 20, and 30 year have come down a little bit as well. Right now, the 10 year is at 3.715. The 2 years at 4.545. Still in yield curve inversion, indicating an oncoming recession, where short-term bonds demand more yield because they have higher risk than longer term. That means the bond market may be predicting a recession. We'll continue to follow that one. Looking over at the futures and commodities markets, energy futures are trading slightly up on the day. Metals futures somewhat down, although platinum, copper, and palladium are up slightly. The rest of the commodities, wheat is up, soybeans are down, corn, sugar, coffee are mixed on the day. Overall, the commodities market looks to be doing okay. I'm going to share a screen and show you some information on the earnings reports from FactSet that I got late last week. FactSet compiles this information for us quite often and prints it so we can look and see what's going on. So I'm going to read some of the key metrics for the earnings scorecard starting up here. For fourth quarter 2022, 69% of S&P 500 companies reporting actual results. 69% of those companies have reported positive EPS surprise, and 63% of S&P 500 companies have reported a positive revenue surprise. However, even though that's the case, we're going to see there are some big time losers, and those losers are dragging the overall metrics down. And you can see that we are on a decrease in terms of earning per share when compared with S&P change on that chart. So we're definitely in a down slope on the earnings. I'm going to go to page 7 and we're going to take a look. Well, actually, we're going to go right up here and look at this chart for a moment. This is the negative earnings surprises average price change over 5 years. So when you have a negative earnings surprise, what type of percent change that has in the actual S&P? Or you can see when you have negative earnings surprise announcements, earnings per share announcement that are a surprise to the market, then you have a fall in the S&P 500. I'm going to read from you on FactSet page 7, where they talk about which sectors have been doing the best. It starts right here. Financial sector has seen the largest decrease in earnings since December 31st. The blended year-over-year earnings decline for quarter 4 2022 of negative 4.9% is below the estimate of negative 3.3 for end of the fourth quarter. 4 sectors have recorded an increase in their earnings growth rate or a decrease in their earnings decline since the end of the quarter due to upward revisions to earnings estimates and positive earning surprises. Overall, we are actually down earnings from where we were this time last year, and down earnings overall for the quarter, even though a lot of companies are doing slightly better. The companies that are doing worse, that 31%, are doing demonstrably worse, and it's dragging down the whole earnings. It looks like we have a negative earnings report for fourth quarter of 2022. If this trend continues, we'll continue to watch it. So I do expect that is mirroring the deflation in CPI. Prices are coming down, less demand. The inventory stuffing back into warehouses, where warehouse receipts are up and warehouse storage is up, and therefore rates on warehouses are up. And we can also see that from the past couple of months, where we noticed like Baltic shipping rates were falling, so we had less inventory coming. So you see all these signs of deflation echoing through the economy, and that's basically where we are. But I do think we're in the first cycle of deflation. They're going to hit second inflationary wave, then a second deflationary wave, and then the final blow off inflation before you have what probably is going to end up being some sort of economic reset or debt reset in the system. I expect that to happen probably, already, the process already started, but it could take a couple of years. We'll follow that as we go along. Looking here on the gold chart at CME Group, you can see that we had lower volume this week. There was a cyber attack. I did talk about that on my channel, to data provider Ion, that then provides, according to the reports, the data for the CFTC. And I think a lot of traders use that data as well. So some of the trading has slowed down. We suspect, because that was first reported on the 2nd and 3rd, that this slowdown in trading may be due to some manual clearing. The CFTC's issued a report saying the clearing has started to speed up, but we still don't have the new COT data. I'm actually going to go over here and show that to you. We still have the data as of January 24th. So we're about a week or so now behind the new COT report. CFTC is not putting out the new one, I assume, either because they haven't gotten that data, or they're sorting through it to determine if there's any weaknesses or issues with that data. We'll continue to cover that story on these week at market wrap-ups. But if big details come out, there'll be separate videos on my channel going over those, much like the original and initial report that I had, but I'll continue to follow that. So we do have Friday's data on open interest in gold. As we look at that, contracts are starting to roll off into June a little bit. While April's a dominant contract month, I expect to see a little bit more roll into futures month at some point in time. Total volume 155,270. We had 2,137 EFPs between COMEX and the London market, and 76 deliveries on the February contract, which is the current trading contract on the COMEX. Don't expect to see a lot of current deliveries on the COMEX because it's not a big trading month, but deliveries will probably ramp up around April as well. This is Thursday data, basically the same trend. More contracts being put on future months and being taken off April. This is just a slow move at the moment. We have had 1,045 exchanged for physicals to the London market, 131 deliveries off of this market. As we go to look at settlements, nothing too interesting here. Again, on the April contract has most of the trades. This is what's going to set the price. Most of them, as of Monday's data so far, being updated as we go along, not real time, but as we go along. Early Monday data has us at 1863.50, trading down 11 bucks. It's 1866 on the current tracker. So this trade data is not point in time. It's aggregated over periods of time, I would assume. And so this is probably closer to the real price. As we look at gold price, it was about 1860. So this data is lagging a little bit, but that's early Monday trading. So go to as Friday closed on the April contract, down about $4, about 410 on either side of that in March and June. The big contracts right here to 1874.50. As we go and look at gold across the pond, we can see over the last 4 weeks, we're now about the same on registered, meaning what is left. And come come and gone, if you will, into the registered liquid category of COMEX over the last month is about break even overall. About 950-ish thousand ounces have been removed from the COMEX overall inventories, although we're even on the registered liquid one. And then overall, less than 1 million over the last 4 weeks have been taken out overall of the ETFs and COMEX, where a lot of that gold is in COMEX stored in the US. If it's ETFs, most of it London, some in the US and other places as well. So we expect about 100,000 ounces has flowed off of the London markets as we look at GLD, which is the dominant one on the chart. Again, still a net outflow for the last couple of years. Don't expect that to change anytime soon. That just means gold and silver continue to roll off the markets. I'll show you the silver data here in a moment, although that has slowed down just a little bit. Going back to silver, I don't know if this is related to the cyber attack or not, but certainly we've seen lower volume there, and it would tend to make sense. Although we do see patterns. We see higher volume, lower volume. Having higher volume on the first couple of days of a delivery month makes sense. So we'll have to see if this extended slower trading continues or trading resumes and we get normal patterns. I'll report that as we get it. Looking at Friday's data on the overall volume, most of that was on the March contract, although you see 6,000 contracts taken off. 4,600 of those rolled into May and then some into future months. So May is quickly going to become the dominant contract month. And that makes sense as we get about the middle of February. People have taken their February, March positions. Now they're rolling to another month if they're going to continue to trade the market. So right now, closed 69,000 contracts on Friday's data, 438 EFPs over to London, 22 deliveries from COMEX. Going down to Thursday's data, same thing. Contracts rolled off. Most of them rolled into May. You can see the 5113 rolling off of March and into May. You did still see the dominant month being March, 75,000 contracts. 385 those exchanged for physical to the London market and only 4 deliveries because February is not a heavy delivery month. Remember, the futures, the paper is traded on a futures month most of the time, or the majority of it will be, while the physical is delivered on the current month. I wanted to point that out if you guys hadn't caught that from my previous presentations. Continuing on, looking at the settlement data. This is Monday's data, not completely up to date, but gives us a snapshot of early trading on Monday. Estimated volume 20,169 silver contracts, settling so far at an average of 21,852, down 22 cents. That is early data on today. Friday's data, 70,093 contracts, settling at 22,075, down 68 cents. Going over to silver depository information from Nick Laird's Gold Charts R Us. Similar things we see in silver to gold. We've had silver flow off about 7.5-ish or so, just doing quick math here, million ounces roll off of the COMEX in the last 4 weeks. And daily, you see it's about 700,000 roll off, mostly eligible category. Overall, though, there's been a net increase in gold, most of it going to London, most of it going, silver, most of it going to SLV. Same thing with GLD, had a little bit more going to GLD as well. So people are starting to invest. I believe this highlights interest from the generalist market in which they want to buy a piece of paper representing silver, hence the SLV ETF, versus owning it and storing it at home or owning it in a depository. So I do think this, along with the article that I did on JM Bullion around Jim Cramer recommending gold, indicates that there is some generalist movement into gold. You can see over the last 4 weeks, we've had a 4% increase moving into SLV for silver. And then if we got, because I keep mentioning gold, if we do GLD, it's been an increase of 1.2. So more silver flowing in than gold into the ETFs, into these passive investments. But you can see interest from the generalist market coming in both silver and gold in the numbers. Again, commitment and trader reports. Not much to say here. It's an old report. It's 2-week-old data. It won't tell us much about what we have seen on the markets here. It's not going to tell us about this trade and what happened in this trade. It's going to tell us all the way back here. That information is not super helpful to us to look back here, and we've got all this data. So I'm just going to show you the COT report is old. I'm not really going to go over it. It's been in a prior report. But in any case, we'll wait and see if the CFTC and ION can deal with that cyber attack and get us the new data back. And hopefully they can certify that the data was not manipulated in and of itself, and we have the correct data as well. London Vault Holdings, we have the new report coming out finally for January holdings for the LBMA for silver. We did lose a little bit of ounces. Previous month, it was 840,913. Now it's 848,77. But it looks like similar to the COMEX, it's plateaued a little bit. On removal of silver and gold, I think there's more silver coming off of COMEX than there is London. But overall, it's kind of plateaued a little bit. So I think that the demand for silver that people had has waned a little bit on the physical side. So maybe the physical trade is coming off just a little bit and lightening up just a little bit here in the Western world. Now, as you move over to the Shanghai, this is Shanghai Gold Exchange. They have their January monthly report. it is right here on this screen. And what I'm gonna do is just go down to the bottom, and instead of going over these tabular numbers and talking about the decreases on deliveries, I'm just gonna show you the deliveries and the amounts. So if you look at the delivery volume in gold, that is this column right here, the left-hand column. Trading volume was pretty good. Delivery ratio for the month of January, 80.95%. That's very high. That means 80.95% of the contracts had physical delivery, at least delivery, according to the Shanghai Gold Exchange. And since this is the beginning of a new year, the accumulated total will be the same because they're counting from January to December. So these numbers will match for this month, and then these numbers will start changing month over month as the monthly numbers change. So we'll just go over the monthly ones here. In silver, 22.26%. Delivery ratio, delivery volume here of 2,451,570 ounces. Withdrawal volume, 32,400. So some actually being taken off the exchange by the withdrawal. As you can see there, not all the deliveries, but some is being taken off. So in Shanghai, lots being moved to private storage, as well as some is actually being pulled off and presumably being used in outside investment and or industry uses. So that's really the tail of the tape. We're going to pay attention to the CPI this week. We paid a lot of attention to the jobs numbers last week and updated you a little bit this week as well. We don't believe the rosy job numbers that the BLS had, but using the BLS's own information, we can explain why that occurred. We think we probably lost jobs last month, but we'll wait for the revised numbers to come out. We continue to see more jobless claims, though, both continuing and especially new ones. So I think there is in that data reflective of some increased joblessness. Of course, we've heard the announcements of the companies as they're laying off, especially in the tech sector, but some others as well. And then to recap as well, with what's going on in the markets, they're pretty buoyant on expectations of a lower CPI. We'll see what happens there. And of course, we'll pay attention to the rest of the retail and housing data as it comes out this week and next and have that updated for you as well. That's going to wrap it up. Thank you so much for joining the weekly market wrap up.